In today's video, we study data back from 1871 to understand what's happened in every single one of the banking crisis periods over the next 3, 6, 12, and even 24 months. And the results might surprise you. We also take another look at smart money versus dumb money ahead of the FOMC statement and expect a 25 basis point rate hike this week. As you may have seen, this was a key level that we had in our weekend video, and markets certainly did like it. We'll be talking about where we're at right now and what we expect moving forward with the data that talks about March into April. There's a lot to discuss. Let's take a look at it all right now together. Well, welcome back everybody to The Daily Show, where we talk about markets around the world. If it's your first time here, welcome. Remember to subscribe and smash that like button if you enjoyed today's content. But we've got a big show coming your way. Macro, news, lead indicators, and the hottest charts with the key levels that you need to be watching. So let's talk about what happens when we have a banking crisis since 1871. Well, it turns out that 1 month later, it's not very good. But 3 months, 6 months, 12 months, and 24 months later, it's a very different story. I want to focus on the first 3 to 6 months with some data that we'll be looking at later on today. But it does show you that 24 months later, funnily enough, markets outperform normal periods of time. And this probably is due to the underperformance or the kangaroo style market we go into in the first 6 months. So will this time be any different? Well, let's take a look at some smart money inflows versus dumb money inflows. Now, this is a different smart money flow chart that we usually show. We've got both in today's video. But you can see that recently the Dow Jones has been suffering quite a lot. A lot of this is due to energy stocks also starting to go down and the old economy stocks, not really liking what's going on, of course, in the finance sector. A lot of finance sector stocks in the Dow as well. So what's happened? Smart money has picked it up. They've started buying the dip as of last week ahead of the FOMC statement. They're probably betting that the Federal Reserve is not going to hold to their word and not going to push the economy to the very brink to deal with inflation. We are obviously speculating on that, and then generally the expectation is 25 basis points. Though I have seen some people sending around documents that claim that the Federal Reserve is basically saying they're going to pause after this. Hey, we don't know which one's true. The problem is there's been a lot of false reports coming out over the markets over the last couple of years with the advent of course, Twitter, YouTube, TikTok, all of these types of things. So I don't want to speculate there. It's just a guess. If I was guessing, I would go with 25 basis points. And then, of course, I would say that the most likely course of action is to say pause, wait for more data, figure out what's going on, and then push the markets if necessary with interest rates. So what's smart money done on our traditional chart over here? Well, you can see that smart money has been injecting itself, especially since the recent dip in the banking crisis. They've actually gone mental and they're buying at a pretty fast rate. Now, why have they done that? Well, a lot of it, I believe, has to do with the Federal Reserve liquidity. We've shared this particular chart before, and I've put it over on Twitter. If you want to follow us, links in the description down below. Click the link tree, come on over to Twitter. It's a great place to be. And you can see here that this is a massive increase. $297 billion last week was injected by the Federal Reserve balance sheet into the markets. This tends to create asset appreciation, and it mostly hits the tech sector. So is the tech sector going up because of rate cuts? I don't believe so. I think it's more of a Federal Reserve balance sheet. Now, this is my own indicator, which is a mixture of things. And you'll notice that it looks a little bit different. But basically, we still see the injection because, of course, I am looking for that Fed injection and some other things. And you can see mid-March, the crisis injection, huge increase. And we've now got more liquidity in the system than we've had realistically pretty much most of 22. And you can also see why 22 was so bad. Now, look at the late December spike on this particular indicator. We went up pretty heavily and we basically ran all the way up and then we started dropping down. I believe this drop down is delayed. So basically what happened is we saw tapering and liquidity starting to get ejected out of the system. And then all of a sudden, the market started to come back down. Then, boom, there goes the dynamite, goes straight back out. And of course, markets are rallying for that reason. They also think that there's a movement and that the Fed should be accommodative. So let's have a look. Well, actually, let's go over here for 1 second and just quickly click on another thing, which is smart money versus dumb money confidence spread. So before we go any further and we look at the data stats, I want to just mention that only 17% of the time do we see readings like this, where we get smart money completely outpacing dumb money. Now, smart money buys the dips. Let's face it, that's what this index is realistically telling us. They love buying the dips. And when we get above that 0.25 reading, we tend to see very strong annualized returns off those bases. But I've got some data stats to really bring up for you that show you what tends to happen. Remember, 3 to 6 months later, we get different reads. Now, when we first get these reads, 1 week later, 2 weeks later, I would say lackluster results. Often the market will actually dip a little bit more coming into those. However, when we get to the 3 months later, some strong stats. Now, this is when smart money and dumb money confidence cycles from negative 0.5 to positive 0.25, just in general. But this time we saw it happen very quickly. So when we see it happen in 30 days, take a look at that result there. 3 months later, the market is up 100% of the data points that we have, which we have a few data points here, and it tends to be up around 4.9%. So it's interesting because, I mean, we've obviously seen it during weird times as well with cascading markets, but overall, they tend to get it right over that medium term kind of picture. And this kind of comes in line with, even if we go into kangaroo scarcity or issues right now, what have we got in our favor of the bulls? Well, you've got central bank liquidity coming back in. And of course, you also have technically these smart money inflows starting to buy the dip. You also do have sentiment. And why do we have sentiment? Because everyone's frankly too bearish. 48.4% of people are bearish as of over 6 month period. This is way up over the last month. I've mentioned this before. In February, around 15th, we were seeing reads that were almost 40% positive, which is above average historical bullishness. Now we're at 19.2% read. Now I expect that to increase and actually improve a little bit this week. But look, I use this as a contrarian indicator. I've brought it up many times before. I think that many times what people generally think is going to happen is usually wrong. And if the price action is showing us one thing and we tend to disagree with that, because of course it doesn't make logical sense, I usually follow the price action. Hey, we are technical analysis traders after all. So what are some other bullish reasons that you could like the markets right now? Well, if you take data stats in, I mentioned this during February, we actually ran almost perfectly this year, mid-Feb to mid-March. The drop-off, 200 plus points on the S&P was almost 350 points, so a lot of points off, more than historically the normal kind of period does. And then we've seen a little bit of a rally recently. We're probably about here at this stage on the S&P. Now, I'm not saying that we go into a full bull run. I don't think that's going to occur, but it's interesting all of this is occurring ahead of the FOMC statement and, of course, the Wednesday market action. Now, why is it important? Because most of us, and a few of you right now, would totally disagree with me and say, Tom, the system is broken. Hey, I agree with you. It's completely broken. The Fed comes out every single time and backs in the banks and backs in these crisis periods with liquidity. We also know that every single time the interest rate markets have actually gone up, and they've gone up in such a steep curve this time, they break something. They've always broken something. And in general, they cause a recession. The problem is, when is the timing of the recession? So the bank bonds at the moment, or not the bank bonds, but the actual bonds out in the markets of treasuries, etc., are showing us that we've got over 50% inversion. That basically means that all the short dates are above the long dates. The bond market is telling us we're going for a recession. But the problem is always timing with everything. If you're looking at a market from a short-term time period, you have to think, okay, well, we could still see a rally for a couple of days, then we could see a drop. And we try to cover both kind of aspects here on the channel, which can be hard, but that's a big thing. Now, there are some times when we've seen crisis periods after these rate hiking cycles where they break something and then they start cutting, and the actual recession happens later on. So could we still skip the recession? Well, I would say generally not, based on what the bond market is telling us. But let's have a look at some of the other reasons we might believe that this is a rally that could still be short-lived. And the first one here is sector relative rotation. Usually at the bottoming of markets, you see the normal three: consumer staples, utilities, and healthcare performing incredibly well. They usually have a 3-month extra good performance. And then after that, that's usually near the end of the bear market. Then we see information technology, communication services, XLC, and consumer discretionary do very well. Now, you could argue that we saw this back last year, being the period of October to December. And what I'll do is I will go out and pull the data from that to see whether it does look like we bottomed off from this aspect of rotation. If you're interested in that, make sure to subscribe because I will do that sometime this week. So why do I bring up recession and non-recession? Because the markets basically are here. Maybe a little bit of a tick up. They're following the no recession path. If a recession does occur, it tends to mean in pretty much every case that we have made new lows after that happens. Now, of course, we don't know what's going into the earnings season, but we're in between seasons right now. So we're basically in a Fed stimulus market. We can tell that by liquidity. We're in a data period market that tends to have rallies in it. And then we're going to move into the new earnings periods. So will earnings start to bring back the stock market to some semblance of reality? Well, this is where I think the system could show breakage points, because even with the Fed liquidity pushing assets, ultimately we're going to base them based on fundamentals, yeah? So we saw forward EPS growth turn negative for the first time in a while. Now, back in 2015-16, if you were trading that market, it was all sorts of kangaroo action going on, up, down, and all around. But certainly a lot of kangaroo action, timing, day trading, all of those types of things were quite good. If we go back to the previous periods during bad times that we've had this happen, forward EPS going negative, bad things happen with big rallies and big dumps. So again, you need to have timings, everything in the back of your mind. What about ERP? Well, this is where I don't think many people are considering it. Mike Wilson from Morgan Stanley Research brought this up. I keep rabbiting on about it because I think it's really important. Equity risk pricing or premium is a big thing. Basically, what's cash giving you? What are stocks giving you? How much do you believe that you should be earning above cash rate to make it worth your while? During recessions, if that does occur, we tend to see this start to spike back up. At the moment, at the time of this recording, I believe the chart's like here. Almost nobody's really considering the risks in the market right now. They're just YOLOing things and buying stuff because they see the Fed's liquidity and say, look at this, we're going in. Yeah, it's okay, but it doesn't mean it's a long-term solution. We also know if the Fed does have to pivot, it means they probably broke something we don't know about yet. And when that happens, you do tend to get further stock market lows. These are some of the more notable ones over the years, average of 28.3% down. So remember, a Fed pivot, if it's talked about being so positively in the market, it's not really positive. It means they broke something, it's bad, and there's only a matter of time till something surfaces. The question is, how fast do central banks react? And I've got to tell you, I've never seen them react so quickly as they do nowadays. It's like a Twitter newsfeed, except they're just printing, or in this case, just putting out hundreds of billions of dollars like this. Just do it, guys. Bang. We're just done. We're in. Credit Suisse, hey, we fixed it. You know, it's amazing how fast they are to do this. So these are all the repricings of the bonds market over the last couple of weeks. We can see here with this gray chart up the top, this is the 8th of March. Things were certainly looking good for the bears. You know, with the pressured high point of maybe even upwards of 6% on the cash rate, we were probably going to do a lot of damage to stocks. However, since that point, even though the central banks and the Fed has done nothing or said nothing about it, markets have repriced and they've gone down to this blue line down here. They basically said, we expect you to go higher, then we want cut on cut on cut on cut on cut on cut. Now, I don't know whether the Federal Reserve will do this. They shouldn't. If they don't, the market will crack it, no doubt, because they expect this. This is what the market has come to expect from the Federal Reserve. Lots of cuts really quickly and supportive monetary policy. Now, if they don't get what they want, usually the market cracks it and has a hissy fit, and that can cause kind of like flash crashes or flash moves in the market. Maybe they blame zero DTE options. I don't know. But overall, this is what I'm kind of thinking right now. The Federal Reserve should basically hold firm. Will they? Who knows? You could disagree with me. Put it in the comments down below if you do. Or if you agree with me, put it in there as well. But yeah, I think that they should go to this new rate hike. They should put it in. They probably should say, well, wait for the data, which is the most likely thing they do. But they do need to hold it a little bit. Remember, we've never beaten inflation without pushing the federal funds rate above the CPI number and then holding it there for a while. Otherwise, it's come back. Will the Federal Reserve and central bankers around the world make the same mistake again? Well, I hope they don't. And I don't know if you hope they don't, but I think instant gratification fixes is the best thing in this market. I'd like to see some stabilization, even if that comes at the cost of stocks for a little while, and then longer term, a better society in terms of the way that we're seeing stocks grow. Remember, eventually we're going to go back to a 5 to 7.5%, 8% kind of market per annum, and we're going to need to use this to probably outperform, which is going to be rotation. So how was the Monday session? Well, it was okay. The things that have been doing well recently, consumer discretionary, tech, and utilities, were flat or down, and gold was still out in front with its big move above 2,000 that we'll talk about soon. So that was pretty much the Monday in a nutshell. If we move over to the last 5 days of rotation, you can really see the story is shown as some of the defensive doing okay, some of the technology stocks doing okay, thanks to, I believe, the federal injection of money. And yeah, rate cuts probably helps as well. And then, of course, gold, the biggest performer, thanks to rate cuts. Energy takes the massive hit thanks to the rate cuts. This is an expected rate cut. Remember, it doesn't happen yet, or it hasn't happened yet. Let's jump into the charts now and take a look at the VIX. First up, the VIX. Where is it? Well, it's coming back down, 24.16. We only just made it to 30. You know, in a general rule of thumb thing, if you kind of think of the VIX as an oscillator at the moment, if you've been buying really at 30 and selling around 2018, you've been doing pretty damn good. You can actually load the SPX on top and have a look, but that's not always the way. But if you were thinking about a very basic strategy, a lot of people do consider these types of things, basically Warren Buffett style, buy fear, sell greed kind of concept. Let's have a look now at the yields. Now, this is where things still are sitting pretty disturbingly low. So it's 4% now by December. So we've had lower. I mean, we went down to 3.5, which, you know, it's unbelievable. But basically, we're still expecting many rate cuts, and you can see the expectations of the market. What will the reality be? It's a big Fed FOMC statement and meeting, because really, if they don't give the market clear direction, maybe the market will hate it. If they don't pause after this and say they're going to look at the data, I think the market will crack it. So again, it's a big time, and all yields are showing very similar things. I think most notable is the US 10-year. If you look at this, the US 10-year is often really dictated to more by the market than the Federal Reserve. So if we move under 3.322 and we start going underneath there, that could show us that the market is deeming that there is a sickness and there is a recession very likely coming. So yeah, 3.32, I think a very important zone on the US 10-year, probably one I'm watching the most. So the markets went up, yet high yields came down. So this will be something that we watch, a very critical point for high yields. If we start seeing high yield bonds dropping and the stock market keeps going up, that can be a warning sign, like a canary in the coal mine saying, hey, you know what? We don't really believe this market move. And I know who I trust. It's not the stock market traders. The bond traders usually are more correct than the stock market traders. So high yields is a good indicator to have. It worked well in 2022 and so far doing well for us in 23. What about treasuries? Well, treasuries aren't exactly flying. They probably should be up a little bit more. Volume, of course, was increased. They won't be able to break through 109.58 without us going underneath 3.32 on the US 10-year, so that'll be important. But I still suspect that we should be here. So Treasury is actually a little bit lackluster. Haven't really changed my opinion on them, but they're certainly not being bought. There's a lot of articles going around claiming that US Treasuries are toxic and stuff. I don't really believe that, but yeah, I mean, overall, probably should be, I mean, if you're thinking about percentages, probably should be about 2.36% better off than it is right now. It's not a trade. It's one of those things that you're buying off yield, and it's sure to move quite a lot based on the FOMC statement. Let's move over here to copper. What's going on with copper? Dr. Copper's not weakened in the last 24 hours, kind of come back to that previous support level. So we often look at this just to see whether the economy is really showing sickness. At the moment, I've been talking about copper weakness from up here. I've consistently said that. So far, so good. Let's find out whether this is a sell point. Basically, in the next 0.2 up to 4, I expect selling to resume on copper. I'd like to see somewhere in here sellers to come back in. US dollar was very weak. Bad daily close for US dollar. Now, it shouldn't really bounce. If it does bounce here, I think it's met by sell demand. We do have a critical level for it to come up to. I'd like to see it here, actually, for the meeting. Now, we didn't get any particular bounce in the end. So we were looking for it. I really wanted to see it. I like the idea of basically seeing a bounce in here or here, and we just didn't quite get the rallies that we were hoping for. We didn't break from this low here back up to 104. If we had, then I believe the DXY was strong. But at this point, it's come back down. Remember, if the Fed pivots, if the Fed does everything the market claims, it's not good for the US dollar. That means lower yields and it becomes less desired. So yeah, pushing back down into a very strong demand, 61.8 fib of the entire pull up. We're coming into critical buying before, big zone moving forward. Certainly one to watch. What about gold? Well, we saw the breach. Let's have a look here. The breach happened. We got above 2,000. I saw a whole bunch of articles coming out. We know that gold struggled up here. Now, this doesn't change my long-term opinion of course, 3,000 over the multiple next couple of years. I still think gold's been suppressed for too long and it will go up. I would believe that it should consolidate here. Take a look at the daily close, long leg doji, high, low, open, close, pretty similar to each other. Basically, that's saying we've reached a point that we like. We're going to now, kind of like structure around and stuff around. If I was to guess, I would say this thing is looking a little bit weak, mostly because the market's actually made a little low here. We do have a little order block through this 1960 zone, so that's going to be one to watch. But I think if it gets up a little bit more, maybe back to 2,000 or something, I could see it selling back down to 1960. At least that's one of my leads at this stage. I'd like to see maybe the DXY get a little bit strong here, then of course start to move down, and then maybe something like that could be the way it kind of plays out. So we'll find out. Dollar index will be one that you're watching though. If dollar index falls, let's say it falls all the way back down to that demand level, we go here, then we go here. That would make the most amount of sense. All right, let's move over to natural gas, natty gas, the Widowmaker. Yeah, look, once we failed to hold this twice and we didn't make a higher high, it was pretty much looking weak. I've warned several times against natural gas. Did I like this zone? Yes. Did we see a bounce? Yes. We saw it twice actually. But I do think that natural gas is an accumulation, and I've always said this, it's hard to stop a freight train. And the freight train at the moment is very weak. So because it's a freight train like this, we could go into a whole pattern accumulation for a while. I'll set an alert for a new low just in case that does occur, because then we could be going into what we call a Wyckoff accumulation. So if we get a new alert, I would think that could be starting of the signs of the bottoming process. I do like so far what we've seen. I do believe this is a key zone and it's critically, showing us some of the nice signs of bottoms, but there's no doubt that there's still a lot of risk here in natural gas. It's not really a trade in my opinion. Let's move over to oil and have a look at oil. So oil hits into 65, very nice level. Actually, my old target, which was 65, finally got hit. I wish I didn't kind of fall apart at 76 last time. I thought 76 was good enough, but yeah, 65 was always my target. So congratulations. I'll give you guys a clap if you made it there. That was pretty amazing. But yeah, we're down in what I would call critical for oil. Oil is going to most likely start to base around here. I do have a couple of key levels that we might want to look at. 69.57. If we manage to breach through there, I feel like oil's pullbacks will be met by a little bit of buy demand. I also like some of the action that's happened recently. We made a lower low and we went down to 65. We then rallied a bit. I expect a pullback somewhere around 66 to be met by some buyers. So I kind of like that at this stage from a potential technical trade. The way that you would look at it from technical perspective, you come back to 66, find buyers, move up to 69, kind of 50, and then find out whether the sellers are there. I don't know if we've bottomed on oil yet. I doubt it. But yeah, very, very nice closures here. Big sell-off. Obviously a bit of an overreaction, at least initially, to yields. But I really like oil at these levels. I'm just now starting to wait for it. And I expect it to probably hover around in these zones for a few weeks to a month. And that's just a guess, but that's what I would hope for. Let's move over to Tesla. So it had an okay session, up 1.73%, bit better than the rest of the market. You can see it's at that 61.8 fib of the last swing low. This was a demand zone that we thought would be bought. I'm still going to go with I want this thing to fill this gap. A lot of people claim, oh, look at the inverse head and shoulders right now. Left shoulder, head, right shoulder. It could still be an inverse head and shoulders if it did this. I'm looking for that huge reaction move to be actually met by a nice pullback. That tends to be how the market works. And Tesla's still at that critical high. It's at that zone where, You could see the markets certainly failing around here. We've got that expected weekly options high kind of sitting around in these zones as well. So some critical stuff kind of floating around there. Let's move over to Apple, because Apple has gone into a very key level. And I mean very key level. Let's look at the daily close. So this is now the highest daily close that we've seen pretty much this entire time. And it's such a critical zone. We've seen wicks here. So there's basically wicks, we're here. If we do breach through with another bullish candle, you have to think Apple's moving towards further bullishness. So it finds itself at an incredibly big zone with an expected weekly options high just above it, ahead of the FOMC. I think there's little coincidence that we're at a critical zone ahead of this period. So Apple floating around. For bears, they're going to be watching this level, very hungry for the salmon over the next 24 hours, finding out whether they can find some weakness. Speaking of salmon and bears, there's NVIDIA, which is still on its epic run, 86% up. We still haven't really seen turnaround. Some people were saying, oh, look, this was an island reversal in the previous session where we opened slightly down. So there's the open there. I do think it's potential. I mean, we've got a gap fill. Look, just like down here, I think you need to see a little bit more. We haven't seen enough yet. I would have liked to have seen one red candle actually come through. It hold the down. Then we could say, okay, yeah, look, we're moving back down. At this point, you're trying to stop another freight train. So remember, AI is super popular. Everyone likes it at the moment. And you can't pop a bubble or pop one of these moves easily. They tend to get a bit crazy and then markets drop off. Have a look at the weekly returns. It's not the first time you've seen this. When these start to get obscene, so like last week was 15.5% up, so that's pretty obscene, definitely more than any standard deviation move. Over here, we've seen upwards of 22%. When they pop with big sell-off day, usually it's over. We're looking for that. We haven't seen anything yet on NVIDIA, so be careful out there. For bulls, you're still dancing. For bears, well, you got to just chill. Just chill, bears, chill. XLY versus XLP, this is consumer discretionary. I like to see consumer discretionary versus staples. It's 1/3 of the US economy, effectively the American consumer. At the moment, the markets are still showing us they believe the American consumer to be weak. So that's interesting. Usually during rallies, you would see this outperforming. That's what tends to happen. It's not, which is, I think, telling of this rally possibly being maybe short-lived or a little bit false for now. And even though smart money's all over it, I don't know whether they're, even with the FOMC or the statement, the funds rate and stuff, even if it starts rallying, it still could be a false rally based on that kind of thing. DAX, what's going on here? DAX came back. I still think the DAX market is fairly weak, but it had a nice rally. It came off this little area in here, which is 14.5. Certainly a little critical zone. So if you bought it there, well done to you. We saw a flash kind of sell-off followed by this big rally. I'd like to see it back at 14,000 still. We'll see whether that can happen. FOMC will be the one that judges it. Same thing on XJO for the Australian viewers out there. We're still in the buy kind of area in terms of, the critical kind of lows. We're putting in a good day today. So this is a good day today, trying to get above those highs. And it's a critical zone. So if the ASX is going to hold, it has to kind of hold here. Let's move over to the big one. I think this was the teller that we were going long. It swept underneath our key levels. 1700 we mentioned on the weekend. Set the alerts. Unfortunately for many of you out there, these alerts would have gone off super early in the morning. I've got this set to, I think, Chicago time. And it was, let me have a look here, 2 hour. It was like 3 a.m. in the morning. Yeah. So bit brutal in terms of when it happened. But yeah, it swung the lows, came back up. Absolutely, once it swung those lows and it came back up. When you counter that with the key level on the S&P, it was a match made in heaven towards markets going bullish. Here's the NASDAQ. Very nice. Oh, by the way, just on the Russell, we haven't actually seen a higher high yet. So if you notice here, even though it went rally, we didn't actually get any switch. So I don't think we're out of the badness yet, but that's certainly a strong candle. I expect a little bit more throughput, maybe end up around that 1780 to 1800 ahead of the FOMC. I'd like to see that type of thing occur. US 100, where are we? Kind of critical as well. Back up into these highs. If we do end up getting a bit of a rally, I'd watch the reaction at 12,742. I think that'll be critical for bears to really try to push it back down. You can see it's a critical level before. So that'll be a big one. If that does happen, so if we go like this, we're probably going back down. So yeah, just look, a lot matters on what happens over the next 2 days. You know, we'll either break high and keep going for a little bit, or we're going to get demolished all the way back down. Q is very similar. You can see the critical zone up here. Should we reach it? So we're waiting for that level from the bull side, and from the bear side, well, we're at a critical zone, but we're not given enough information yet. SPY, expected highs and lows. You can see the key levels here for the week ahead if you're interested. And SPX, we had that very important 39.75 zone. Now, when we look at the S&P futures, you'll see we're very close to that again. Very critical zone, the 39.75. We used it last week, which is right here, 39.75, to show us that the markets would most likely go down. They did. And then boom, straight onto the trend line here. Wow. That was a phenomenal 3 a.m. kind of action. With the US 2000 and this level combined, I haven't stacked a level like that in a while. So I was pretty sure on this one. Great level. You know, the difference between good traders or bad traders really is not necessarily your ability to predict, but it's your ability to recognize when you have some kind of statistical edge. And that was a banging zone. So congrats if you got that big move off the bottom. I mean, we had basically a 2.4% switch, which is nothing to laugh at on S&P. And we find ourselves back at 39, basically 75 ahead of the market open. I expect something in here to still be weak. And I'd like to see now weakness into some strength. So if you pulled like a fib or something, just looking at a 61.8 fib, let's say, then you'd be looking at the market coming back down somewhere, I think, around this structure here, about 39.12. So we've been following it up if you're watching the live stream yesterday. And yeah, realistically, somewhere in here is where I'd like to see the market find rebuyers. So something like that. So sell off into buy would be the optimum kind of thing to happen during the Tuesday session. Will it? Don't know. If it breaches through 39.75, that'll be very interesting because we know we have supply over here. So this is a critical level of supply. So if we go back into this, the reactions in here, this is where I believe bears are. This is where I believe the bulls are at this stage as of the current time. Two extremes leading into a big level. Let's refresh the option strikes. We'll have a look here at the option strikes. Then we'll get into some crypto analysis. And option strikes leading into the 24th, 769,000. So basically nothing around. 378 puts mostly, 393. There's not much. I mean, max pain's 395. I wouldn't say there's too much here to worry about each way. So yeah, look, there's a bit of options. They're mostly on puts. On the call side, 395, 400s. So we're kind of approaching that side where the market might want to stay below this week. It doesn't mean it has to. This is not a third week options expiration. For Bitcoin, it looks a lot better. It just continues to be, we are ideally moving to 30,200 or something in this red box up here. We broke out the 25.2. So far, we're almost $3,000 above that, which is what I expect. I ideally would like to see $5,000 above that because that's what really the market's telling us. We broke a key zone. We put a lot of pressure on this zone for a while, and then boom, goes the dynamite. So at this point, Bitcoin's fairly good looking. Ethereum obviously is struggling behind it, and that's because Bitcoin usually leads the way and the rest of the cryptos come with it if it can hold its own. And I think this will be the day that everything moves. FOMC, economic projections, statement, funds rate, and conference. Between the funds rate release and the conference can be a very volatile time. So that's 2 p.m. New York to 2:30 p.m. New York. Watch that one. And as we scroll down, we also get some other information here, including flash services, PMI, and all of that good stuff. So be careful out there, guys. This is a massive event. And as you know, it's all happening right now. We'll do the March giveaway draw in the next video. So watch that if you entered it. That's now closed. So thanks so much for anyone that entered. It's completely free to do so. If you're interested in following us on the socials, then do so. Also get 3 free trading cheat sheets. It's as easy as just clicking and signing up. And yeah, completely free. So thanks so much for watching. Subscribe, smash that like button, and good luck out there in what is going to be a very interesting Wednesday. Bye for now.